Okay, let's unpack this. We're diving into a major financial narrative this time. It's about this recent JPMorgan report that's really making waves, not just looking back at Coinbase. It's trying to, value its future. Pretty fundamental shift in how institutions might see a big crypto exchange.
That's right. And what's really fascinating, I think, is that JP Morgan's equity team didn't just reiterate their rating, they actually raised it. And they lifted their December 2026 price target for Coinbase way up to $404.
Wow, $404.
Yeah.
That's a massive vote of confidence, especially when you think about where the stock was trading, right? Around $355 when the report came out.
Exactly. So they're seeing almost 15% upside. And importantly, it's built on these emerging monetization streams and, well, what they see as lower regulatory risk now.
Yeah, institutional backing like that really signals something's changing.
Yeah.
The core idea seems to be Coinbase isn't just about those volatile trading fees anymore.
Precisely. They're moving towards what the report calls deeper on-chain monetization. Think of it like Amazon, maybe. It started as a bookstore, then boom, AWS infrastructure became the real moneymaker.
Right.
JP Morgan kind of sees Coinbase doing something similar, moving from just a trading place to being, well, essential infrastructure.
That's a great analogy. Really frames the shift. So, okay, if it's infrastructure, what are these new revenue streams? What gets them to that $404 target?
So the analysts basically flagged three main things, three levers that could unlock billions. First, and this is the big one, the potential value of a token for their base network. Second, a pretty clever shift in how they handle rewards for USDC stablecoins. And third, a way to sort of defend against DXs, a decentralized exchange hedge strategy. That's kind of our roadmap for this deep dive.
Okay, let's definitely start with the big one then, the base token potential. Because, yeah, the numbers JP Morgan threw out there,
Yeah.
they're kind of staggering, right?
They really are. The bank modeled a potential market cap over time for a base that's Coinbase's layer 2 network on Ethereum. Somewhere between $12 billion and $34 billion.
$34 billion for a token that doesn't even exist yet.
Well, for the network, which the token would represent, yeah, it's this idea of equitizing the success of the infrastructure they've built. That's the key phrase.
Equitizing success. Okay, what does that actually mean for Coinbase's, bottom line? How does that translate into value for the company itself?
So the way the analysts modeled it, they figured Coinbase would probably hold on to about 40% of the initial tokens.
Okay.
Now, if you take that $34 billion market cap at the high end, 40% of that, that's roughly $12 billion in direct equity value for Coinbase.
$12 billion
Yeah.
just added to their value, not from trading, but from owning part of the network itself.
Exactly. It's value derived from the utility and the success of the underlying network.
Right. So why are these analysts so bullish on Base? I mean, it's relatively new, launched August 2023. What are the metrics making them think it's worth that much?
Well, they looked at a couple of things. First, just the sheer speed of its growth. Dayfalama data shows Base already has over $5 billion locked up in it, TVL. That's fast.
5 billion TVL. Yeah, that's significant.
And second, the activity. Base is apparently handling over 9 million transactions daily. That's not just speculation. That suggests real applications are being used there.
And an L2 is built for scale, right? So
Yeah.
Coinbase controlling their own L2, it's like full vertical integration. They control the environment, the fees, the experience.
That's a really good way to put it. Full vertical integration.
But dig into the mechanics a bit more. If Base gets a token, where's the actual money coming from? How does Coinbase capture that value?
Okay, so it mainly comes down to the sequencer. On most layer 2s, the sequencer is the thing that bundles up transactions and sends them back down to Ethereum.
And Coinbase runs the sequencer for Base.
Exactly. And that sequencer charges a small fee for every single transaction it processes. So a Base token would essentially represent a claim on some portion of those future sequencer fees.
Oh.
Or maybe it gives governance rights, influence over how those fees work. By holding 40% of the token, Coinbase gets a huge piece of that future fee income from this high-volume network they built.
Got it. So that's the equitizing success part. Makes sense. Now, Coinbase itself has been kind of cautious publicly, haven't they? Jesse Pollack, the Base creator, said they're beginning to explore a token for decentralization.
Right. That's the public line, decentralization. But yeah, Brian Armstrong, CEO, also confirmed on X or Twitter that they're looking into it. But, and this is key, no definitive plans.
So JP Morgan is basically pricing in a very likely strategic move, not a sure thing.
Pretty much. They're valuing a highly probable future cash flow stream, which tells you, I think, how important they see this L2 token model becoming for centralized exchanges going forward.
Absolutely. Okay, so the Base token is, let's say, the potential multi-billion-dollar upside bet. Let's shift to something more immediate. The USDC rewards change. You called it an operational lever.
Yeah, this one's much more concrete. It's really an efficiency play. Right now, Coinbase earns interest because customers hold USDC stablecoins with them. Circle pays Coinbase for those reserves.
And that's a fair bit of money, right?
It is about $400 million a year, roughly. But here's the thing. Coinbase currently gives most of that interest back to the customers as rewards, to encourage people to hold stablecoins there.
Generous, but maybe not the most profitable way to do it.
Exactly. It's an opportunity cost.
So what's the proposed change that could boost their margins?
The analyst pointed out that Coinbase is looking at potentially limiting those high-yield rewards only to people who pay for Coinbase One, their subscription service.
Ah, like a tiered model.
Yes.
Similar to what Robinhood does with Robinhood Gold?
Precisely. Offer the premium yield only to paying members.
Okay, so the big question then. What's the immediate financial impact? If regular users don't get that yield anymore, how much does Coinbase get to keep?
JPMorgan ran the numbers. They estimate that if only Coinbase One members got the yield, Coinbase could keep about $374 million annually that they're currently paying out.
Wow. Nearly $400 million straight to the bottom line. That's significant.
It's a huge potential boost to their gross margin, almost like finding free money, operationally speaking.
But hang on. Isn't there a risk if they cut the yield for most users, won't people just move their USDC somewhere else, like to another platform or into DeFi where they can get yield?
Yeah.
Is keeping $374 million worth potentially losing users?
That's the gamble, absolutely. And the analysts must have weighed that. They're essentially betting that Coinbase has enough stickiness.
Stickiness. You mean brand loyalty, ease of use?
Yeah, the trusted brand, the regulatory sort of safety net people feel, and especially the tight integration with the Base ecosystem now. The idea is the convenience and security of staying within Coinbase, particularly if you're using Base apps, might be worth more to users than chasing a slightly higher yield elsewhere.
They're banking on the ecosystem keeping people locked in, even with less attractive rates.
Basically, yes. They think the ecosystem is strong enough to withstand it.
Okay, it's a calculated risk.
Yeah.
But if it works, yeah, massive immediate profit boost. That makes sense. So we've got the potential billions from Base, the operational hundreds of millions from USDC. What's the third lever? Defending against DeFi.
Right. This is the defensive play, the DEX aggregation hedge. Because, let's face it, decentralized exchanges are a real threat. DEXs now handle something like 25% of all crypto spot trading.
A quarter of the market. Yeah, that's volume CEXs like Coinbase are losing out on.
Exactly. So Coinbase needs a way to stop that bleeding, or at least manage it.
So how do they do that? How do you hedge against DeFi growth when you're a centralized exchange? Seems counterintuitive.
Well, the strategy is pretty smart, actually. It combines that vertical integration we talked about with aggregation. Coinbase built a DEX aggregator into their Base app.
Okay, what does that mean for the user?
It means if you want to trade some obscure altcoin or something with low liquidity on Coinbase itself, you might need to tap into a DEX liquidity pool like Uniswap, instead of making you leave the Coinbase app to go do that.
They wrote the trade for you behind the scenes.
Exactly. The Coinbase aggregator finds the best price on a DEX and executes the trade for you, but you stay within the Coinbase environment.
Okay, nice user experience.
Yeah.
But how does Coinbase make money on a trade happening on a DEX?
Well, a couple of ways. First, they keep you in their ecosystem. Your data, your future trades, still theirs. But second, and this is the clever part,
Yeah.
if that trade, even though it's going to a DEX pool, is processed on the Base network, it still has to go through the Base sequencer.
Ah, the sequencer again.
Yeah.
So they still collect the transaction fee on Base.
Got it. They own the rails, the infrastructure base that the transaction runs on. So they're essentially saying, look, go ahead, trade those decentralized assets. You can do it right here through our app. And by the way, you'll pay us the L2 fee for using our network to do it.
That's really smart. It takes the growth of DEXs and turns it into a revenue stream for their own infrastructure.
It's a perfect example of managing risk through that vertical integration. Masterclass, really.
Okay, that really clarifies that phrase, deeper on-chain monetization. It all starts to click now. We've got the Base token value, potentially huge, the USDC yield savings, much more immediate, and this DX hedge capturing fees from DeFi activity.
And when you put those three together,
Yeah.
you can see why JPMorgan's model gets so bullish. They're not just modeling an exchange anymore. They're modeling a company shifting from relying on those, up and down trading fees to generating more predictable, higher margin revenue from owning the infrastructure, integrating vertically, and managing their capital smarter.
Right. Let's just quickly bring it back to the stock price again. That 440 target by December 2026, given everything, does that feel achievable now?
Well, history suggests it's definitely in the realm of possibility. Remember, Coinbase stock actually hit nearly $430 back in July.
Oh, yeah, that was around the time of that Genius Act stablecoin bill momentum, wasn't it?
Exactly. So the market has shown it's willing to value Coinbase that high under the right conditions. This JPMorgan report basically gives a new narrative, a new financial roadmap for how they could get back
Yeah.
there, maybe even without a big regulatory win, just through executing on this tech and operational strategy.
So it feels like the big money, the institutions, are finally starting to value Coinbase less like a simple broker and more like a tech infrastructure company.
I think that's exactly right. They're seeing the value in the whole ecosystem, not just the trading platform itself.
Okay, so we've really dug into the mechanics behind this aggressive target from JPMorgan. The potential, what was it, up to $34 billion market cap for a base token,
Yeah.
and maybe grabbing back almost $400 million a year just from tweaking USDC yield. Those are pretty transformative numbers.
Definitely. And it brings up one last kind of provocative thought for you, for everyone listening. If Coinbase pulls this off, if they really do equitize the success of Base and make these other shifts work,
Yeah.
does this basically force every major centralized exchange to do the same thing? Do they all have to stop being just trading platforms and become these hybrid tech firms, building out L2s, focusing on infrastructure, developing ecosystems, just to survive and grow?
That's the big question, isn't it?
That is the multi-billion-dollar question. And JP Morgan, well, they just put a potential price tag on the answer.